going to be looking at the most interesting standard, which is International Accounting Standard 2 Inventories. I'm going to show you how to understand the standard and what you need to highlight when you're going through the reading of the standards. It is important for you to understand when the standard came into effect, what is it replacing, and all those sorts of information. For that reason, we will go through the entire 14 page of the standard together in order to see what are kind of things that you need to highlight and take into mind when it's coming to the standard or the standard reading. Now let's just look together. In April 2001, the International Accounting Standard Board adopted International Accounting Standard 2 Inventories, which had originally been issued by the International Accounting Standard Committee in December 1993. The International Accounting Standard 2 Inventories replace International Accounting Standard 2 valuation and presentation of inventory in the concepts of the historical cost system. So what is important as you say this, you know that the adoption was as from April 2001, right? And then you know that originally the standard before that, it was originally valuation and presentation of the inventory in the concepts of the historical cost system, right? That was when it was first issued in October 1975. So that was years ago. That is, maybe most of you were even born, and also that include myself. In December 2003, the board issued a revised International Accounting Standard 2 as part of its agenda of ethical projects. The revised International Accounting Standard 2 also incorporated the guidance contained in the related interpretation, which is SIC 1, Consistence Difference Cost Formula for Inventories. So if you are reading International Accounting Standard 2, it is important to also look at SIC 1, which is Consistency Different Cost Formulas for Inventory, for you to understand the cost formulas for inventory and to understand deeper International Accounting Standard 2. It is very important, candidates, that you also look at SIC 1. So now you understand why it is important when you're reading the standard to read everything and read the background, highlight what is important, then in the future when you are revising or you're summarizing the standard, you are able to see what was important when you were reading the full standard. Other standards have made minor consequential amendments to International Accounting Standard 2. They include the IFRS 13 Fair Value Measurement issued in May 2011. IFRS 9 Financial Instrument, Hedge Accounting, and amendments to IFRS 9, IFRS 7, and 39, issued in November 2013. IFRS 15 Revenue from Contracts with Customers, it was issued in May 2014, and IFRS 9 Financial Instrument, which was issued in July 2014, as well as IFRS 16 Leases issued in January 2016. So it is important for you to know this because there are other standards that have made minor consequential amendments to IFRS 2. So those standards are therefore linked with International Accounting Standard 2. However, it is not very important for you to go and read all the standards when you are reading IFRS International Accounting Standard 2. However, it is important that you go and check SIC 1. When you are doing the standards, then you see how they link each together. So you understand the interlink. But it's important you look at SIC 1 when you're reading International Accounting Standard 2. Now let's just go further and see what is coming on the other page. When we're looking on the other page, we have the table of content, right? So in terms of what is sitting where. The first part, obviously, we are talking about International Accounting Standard 2, which is inventory. On the first page, you will have objective. There's a scope, definition, measurements of inventories, cost of inventories, cost formulas, net realizable value, recognition as an expense, disclosure, effective date, withdrawal of other pronouncement, appendix, and amendments of other pronouncements. So that means we are going to read a total of 41 paragraphs. Now let's just see what we have, right? So if we go down, there's approval by the board of the International Accounting Standard 2 issued in December 2003 for the basis for conclusion, C, part C of the edition, basis for conclusion. International Accounting Standard 2 inventories is set out in the paragraph 1 to 42 and the appendix. So why it is important is to look here is that you need to understand that this standard, if you want to understand the standard in depth, in detail, you need to go through paragraph 1 to 42 as well as the appendix, right? So it is important that you take note of that. All the paragraphs have equal authority to retain the IASC format of the standard when it is adopted by the International Accounting Standard Board. International Accounting Standard 2 should be read in the concepts of its objectives and the basis for conclusion, the preface for the IFRA standard, and the conceptual framework of financial reporting. The International Accounting Standard 8, Accounting Policies Change in the Accounting Estimate and Error, provides a basis for the selecting and applying accounting policies in the absence of explicit guidance. So now let's say there is an error in the recognition of the inventory, then you need to apply International Accounting Standard 8. So it's telling us what is the link between the International Accounting Standard 2 and International Accounting Standard 8. So if there are errors that came about in the recognition of inventory, then you will need to therefore apply the other standard, and that standard is called International Accounting Standard 8, Accounting Policies Change in Accounting Estimate and Errors. Now we're looking at paragraph 1, which is the objective. What is the main objective of the standard? What is the main objective of IAS2 inventories? The objective of the standard is to predict the accounting treatment for inventories. A primary issue in accounting for inventory is the amount of cost to be recognized as an asset and carried forward until the related revenue are recognized. This standard provides guidance on the determination of the cost and its subsequent recognition as an expense, including any write-down to net realizable value. It also provides guidance on the cost formulas that are used to assign cost of inventory. So why do we have the standard? What is the main objective that we have the standard? We have the standard because we need to understand what is the accounting treatment of the inventory and what cost should be considered or included when measuring the inventory. And what and when should we reduce the value of inventory in our books? And when should we derecognize the inventory? So the most important thing that are important when it's come to the standard that the candidate needs to understand that this is an objective of the standard is that the main objective of the standard is to look at the accounting treatments for the inventory, right? What is the value that should be recognized? What is the cost that should be recognized for the inventory? What is the subsequent recognition of the inventory? That is obviously when there is a sale. So when there is a sale, it means that there should be a subsequent recognition of inventory, meaning to say now you're de-recognizing inventory and you're recognizing the expense, which is what we call cost of sales. There are other instances where the value of inventory has dropped due to internal or external factors. In that way, then they need to be written down to the net realizable value. So those are the most important things that you need to understand. It's the pillar and the main objective of the standard. First is to determine what is the cost, and when determining the cost, what are those costs that should be included in order to determine the final value of the inventory. Now that you have the inventory in your books, what happens if there are external or internal factors that cause the value of inventory to be lower than what it was when it was initially recognized? Now you need to bring the inventory to the net realizable value, which is the value that you expected that this inventory is worth after this external and internal factor that had came into effect. Now let's say things all went well after the initial recognition. There were no issues that were determined. Therefore, the inventory is now sold at a value that they initially expected to sell this inventory at. Now, when the sale is made, something has to happen. So, what is that thing that need to happen when there is a sale that is made? So, if there is a sale that is made, it then basically mean that there needs to be a recognition of asset, which is an inventory, and then a recognition of cost of sales because now there is a sale. So that is a basic objective of the standard, is to look at the cost, is to look at the recognition of the cost or reducing of the cost. Now let us look at paragraph 2. And paragraph 2, it is basically contain the scope. This standard applies to all inventory except. It is very, very important, candidate, to understand when they say except, then whatever that they're saying, it's not included, you should not take into account. When you're looking at A, it was deleted, and then they're saying the standard does not apply to the financial instrument. So you need to put that in your summary to say the standard does not apply to the financial instrument, which is the International Accounting Standard 32 as well as IFRS 9. So this standard doesn't apply to it, as well as the biological asset. The biological asset is related to agricultural activities and agricultural produce at the point of harvest. So it doesn't apply to the three main standards. And what are those standards? We're looking at the International Accounting Standard 32, IFRS 9, as well as International Accounting Standard 41. So you need to take into account in your summary when you're summarizing the standard to say in this standard or in International Accounting Standard 2 inventory, it does not apply to the financial instrument as well as biological asset. And then we're looking at paragraph 3. This standard does not apply to the measurement of inventory held by producers of the agricultural and forest products, agricultural produce after harvest, and minerals and mineral products, to the extent that they are measured at the net realizable value in accordance with the well-established practice in those industries. When such inventories are measured at net realizable value, changes in that value are recognized in profit or loss in the period of change. It is important that you see that they are saying more further in terms of why International Accounting Standard 41 is not used when it comes to the measurement of the agricultural produced. Then other ones, it's commodity broker traders who measures their inventory at fair value less cost to sell. When such inventories are measured at fair value less cost to sell, changes in fair value less cost to sell are recognized in profit or loss in the period of the change. Now, so it basically talks about then when does the standard not apply in the measurement of inventory. So we are told that obviously it is in the agriculture and forest products, as well as the second one, it is in the commodity broker traders. And then we are told how do they go about measuring the value. It is not important for us now to look at how this agriculture and broker traders are measuring the value, as we are not dealing with that for now. Our main focus is to understand the International Accounting Standard 2. Now let us look at paragraph 4. The inventories referred to in paragraph 3A are measured at net realizable value at certain stages of production. Right, so they are stating more details about this paragraph. This occurs, for example, when agricultural crops have been harvested or minerals have been extracted and sale is assured under a forward contract or government guarantees, or when an active market exists and where is a negligible risk of failure to sell. These inventories are excluded from only the measurements requirement of the standards. Again, this is paragraph, it's not important for your best understanding of IFRS 2 as it talk about exclusion. So for that reason, it is not important for you. And then looking at broker traders are those who buy or sell commodities for others or their own accounts. The inventories referred to in paragraph 3b are primarily occurred with the purpose of selling in the near future, and paragraph profit from fluctuation in price or broker traders margin. When these inventories are measured at fair value less cost to sell, they are excluded from only the management requirements of the standards. Again, candidates, when we're looking at paragraph 5, it is very important to understand that when we're looking at paragraph 5, it's also talking about the exclusion. So for that reason, for your best understanding of this standard, it is not important for you to worry about paragraph 4 and 5. Now let's just look at what we have in the next paragraphs. So we're starting now with the definitions. So the definitions will assist you to better understand the terms that are important in the standard, which is International Accounting Standard 2. Definition: the following terms are used in the standard with the meaning specified. The first one is inventory. What are the inventories? Inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of material or supplier to be measured in the production process or in the rendering services. So what is important for you to understand when it comes to inventory? They are in the ordinary course of business, meaning that you are buying these inventories for the purpose of selling them to the customers. That means in the future, this asset is held for the short term. It's expected to be held for the short term and not for the longer term. Or it could be in the process of production. So what does that mean? It means you are buying raw material to make the final product. So that raw material that you need to make the final product, it is also inventory because you need it in order to produce your final product. And then in the form of material or supplies to be consumed in the production process or in the rendering of services, right? So this is important that also you understand that the supplies or material that are used in order to render the services or in the process of production are also called inventories. And then the next important word that you need to understand in the inventory standard, it is what we call net realizable value. Is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. So now what is this net realizable value? It is the estimated selling price, what you sell the product for in the ordinary course of business, less the estimated cost of completing this inventory if it was still in the production phase, and any estimated cost necessary to make the sale. So now if someone is saying, please calculate the net realizable value, I have the estimated price of 10 rand, I have the estimated completion of 5 rand, as well as the estimated selling price of 1 rand. That means the net realizable value, it is going to be 4 rand. So it is important to understand how to arrive at the final point. So it is the total cost to sell that product, less the completion if it's still raw material, then less the cost to make the actual sale for the product. Then we're moving to fair value. And fair value is the price that would be received to sell an asset or paid to transfer the liability in the ordinary transaction between market participants at the measurement date. This is very important when we're talking about IFRS 13 fair value measurement, which is also interlinked to the standard. Now, paragraph 7, we are looking at net realizable value refers to the net amount that an entity expects to realize from the sale of inventory in the ordinary course of business. Fair value reflects the price at which the ordinary transaction to sell the same inventory in the principal or most advantageous market for that inventory would have taken place between market participants at the measurement date. The former is an entity-specific value, the latter is not. Net realizable value for inventory may not equal fair value less cost to sell, right? It's very important to understand that the fair value as per IFRS 13 and the net realizable value as per International Accounting Standard 2 might not always be the same. So this standard basically differentiates the two and explain what is the fair value as well as what is the net realizable value in detail. Now let's just look at 8. Inventories encompasses goods purchased and held for resale, including, for example, merchandise purchased by the retailer and held for sale, or land and other property held for resale, Inventories also it encompasses finished goods produced or work in progress being produced by the entity and include material and supplies awaiting use in the production process. Costs incurred to fulfill a contract with a customer that do not give rise to inventories or assets within the scope of another standard accounted for in accordance with IFRS 15 revenue from contracts with customer. Again, when you look here, we are explaining further that when it comes to inventory, you do not need to think that when we're talking about inventory, we're only talking about certain things like your pocket or a sale of packet of sheets or a sale of the small item, but it also includes big assets like your land, your property, as long as you are holding those assets for the purpose of resale. So paragraph 8 emphasizes the better understanding of inventory by stating the big asset, that those big assets, if they are held by the owner for the purpose of resale in future, therefore they can form part of the inventory. Then when you're looking at the next paragraph, we're looking at the measurement of inventory. Inventory shall be measured at a lower of cost and the net realizable value. It is important for you to understand that when it comes to measuring of inventory, it should be at the lower of cost, which is the cost to acquire the inventory, including all the necessary costs to bring that inventory to the location and position that enabled it to be used by management, and net realizable value, which is the cost expected to be received from sale less the expected cost of completion less the expected cost to sell. So it is very important that you keep on understanding what is net realizable value is in the concepts of inventory or standard 2. And when we're looking at paragraph 10, it's the cost of inventory. The cost of inventory shall comprise all the cost of purchase, cost of conversion, and other costs incurred in bringing the inventory to their present location and condition. So what are the most important costs that you need to think of when it comes to measuring the inventory? So it will be cost to purchase. How much does it cost you to purchase the item of inventory? If it is a final product, then it is gonna end there and maybe the traveling cost. However, if it's need to be converted, that means it's a raw material. The cost of conversion need to be taken into account in other costs incurred to bring the inventory to the present location and condition as intended by management. So now, what could be other costs? Other costs could be costs relating to maybe transporting, assembling, and other costs that are necessary to bring this inventory to the location and condition that is required by management. Then looking at paragraph 11, it's about cost of purchase. The cost of purchase of inventory comprises the purchase price, import duties, and other taxes, other than those subsequently recovered by the entity from taxing authority, and transport, handling, and other costs directly attributable to the acquisition of finished goods, material, and services. Trade discount, rebates, and other similar items are deducted in determining the cost of purchase. So it is very important, candidate, to understand that the trade discount, rebates, and other similar items are deducted in determining the cost of the purchase price, because those costs are basically not what the entity would have incurred in order to get that inventory. And other costs that you need to understand should not be part of the inventory are any costs that will be received or claimed from the taxing authority. And the example of that will be maybe the VAT, if the VAT was charged to the entity or to the business and they are able to claim that VAT from the taxing authority. And then we're going to look at the cost of conversion. What are the costs of conversion? The cost of conversion of the inventory include costs directly related to the units of production, such as the direct labor. They also include the systematic allocation of fixed and variable production overheads that are incurred in the converting material into finished goods, fixed production overheads, and those directly costs of production that remain relatively constant regardless of the volume of production, such as depreciation and maintenance of factory building, equipment and right of use of asset used in the production process, and the cost of factory management and administration, Variable production overheads are those direct costs of production that vary directly or nearly directly with the volume of production, such as indirect material and indirect labor. So now, cost of conversion, obviously, those are the costs that directly are in line in order to bring the asset to the condition that is required by management. And the example, it will be the direct labor and also the cost of allocating fixed and variable costs, and also other costs that we can see here. It could be the cost of equipment, machinery that is used to bring the inventory to the location and condition that is required by management. If we move down, we're still on cost of conversion, which is paragraph 13. The allocation of fixed production overheads on the cost of conversion is based on the normal capacity of the production facility. Normal capacity is the production expected to be achieved on average over a number of period or season under normal circumstances, taking into account the loss of capacity resulting from plant maintenance. The actual level of production may be used in the approximate normal capacity. The amount of fixed overhead allocation to each unit of production is not increased as a consequence of low production or idle plant. Unallocated overheads are recognized as an expense in the period in which they are incurred. In a period of abnormal high production, the amount of fixed overhead allocated to each unit of production is decreased so that inventories are not measured above cost. Variable production overheads allocated to each unit of production on the basis of actual use of the production facility. So when we're looking at the paragraph 13, it talks about the allocation. It's mainly focusing on the allocation of fixed overheads to the cost of conversion. So they're saying what do we do with the idle time, and also what do we do with abnormal high production. So those are the most important things that you need to highlight and think of when it comes to this paragraph. And the last part, it talks about variable production overheads, which you need to understand the allocation of it thereof. Now we're going to be looking at 14. A production process may result in more than one product being produced simultaneously. This is the case, for example, when joined products are produced, or when there is a main product and a byproduct. When the cost of conversion of each product are not separately identifiable, they are allocated between the products on the rational and consistent basis. The location may be based, for example, on the relative sales value of the products, either at the stage in the production process when the products become separately identifiable, or at the completion of production. Most byproducts, by their nature, are immaterial. When this is the case, they are often measured at net realizable value, and this value is deducted from the cost of the main products. As a result, the carrying amount of the main product is not materially different from its cost. So when you're looking at this one now, you're introducing the term byproduct. And the byproduct is basically when the production of one item can lead to other minor products being produced. Meaning to say there's a main product and the byproducts, or the product that came about because we were trying to produce the main products. And then when that happens, so what does that mean? So in the cases when we have instances of the byproduct is normally very small in terms of value when compared with the main products. Therefore, it does not result to the main products being different from its cost, or what it would have been should there be no byproduct. And then the next one that you're going to be looking at, it will be paragraph 15, which is basically other cost. So what are other costs now that need to be considered when determining the value of the inventory? So we need to understand those other costs and see how they came about and what the influence that they have. Looking at other costs are included in the cost of inventory only to the extent that they are incurred in bringing the inventory to their present location and condition. For example, it may be appropriate to include non-production overheads or cost of designing product for a specific customer in the cost of inventory. So now we are told that these other costs need to be included to the extent that they were needed to bring the inventory to the present condition and location. Meaning to say the condition and location that is required to bring the asset to the condition that is required by management. And then when we look at paragraph 16, we have the examples of costs that are excluded from the cost of inventory and recognized as an expense in the period in which they occurred. So now there are costs that should not form part of the cost of the inventory. So these costs are excluded from the cost of inventory and recognized as an expense in the period in which they occurred. And when we look at its abnormal amounts of wasted material, labor, and other production costs, so abnormality, any abnormality that happens in either the material, the production, or labor should be excluded in determining the cost of the inventory. So those costs should not be included in determining the cost of the inventory and should not be recognized as an asset. The next one is storage cost, unless these costs are necessary in the production in the production process before a further production cost. So the storage cost should not be included in the cost of inventory unless it wasn't necessary to bring this inventory to the condition and location that is required by management. Administrative overheads that do not contribute to bring inventory to their present location and condition, that also should be excluded when looking at the value of the inventory. And also the last part is the selling cost. The selling cost should also not be included in the value of the inventory. So just to summarize, what are those costs that you should never include when determining the cost of the inventory? Are costs like your abnormal cost, your storage cost, administrative overhead that do not bring the inventory to the present location and condition required by management. And also the last part, it is the selling cost. Now when we're looking at 17 talks about the borrowing cost. It talks about the borrowing cost. International Accounting Standard 23 borrowing cost identify limited circumstances where borrowing costs are included in the cost of inventories. So there are very, very limited circumstances where the borrowing costs are included in the value of inventory. Like the asset that take longer to be manufactured, where most likely that if the way borrowing that took place, then they might need to consider the borrowing. And then 18, an entity may purchase inventory on deferred settlement terms when the arrangement effectively contain a financial element. That element, for the example, the difference between the purchase price for normal credit terms and the amount paid is recognized as interest expense over the period of the financing. So it's also talking about the matters where there's a deferred settlement terms that has taken place. So when that happens, then there should be an interest that needed to be recognized over the period of the financing. And then paragraph 19 was deleted in the year 2003. Then we are going to look at paragraph 20. So what is in paragraph 20? Paragraph 20 look at cost of agricultural produce harvested from biological asset. In accordance with the International Accounting Standard 41, agricultural inventory comprising of agricultural produce that an entity has harvested from the biological asset are measured on initial recognition at their fair value less cost to sell at the point of harvest. This is the cost of inventory at that date of application of the standard. Then when we're looking at paragraph 21, it starts with technical for measurements of cost. So the techniques for the measurement of cost. Techniques for the measurements of cost of inventory, such as the standard cost method or the retail method, may be used for convenient in the result approximate cost. Standard costs take into account the normal levels of material and supplies, labor, efficient capacity utilization. These are regularly reviewed and, if necessary, revised in light of the current condition. The retail method is often used in the retail industry for measuring inventories of large number of rapidly changing terms with similar margin, for which it is applicable to use other costing method. The cost of the inventory is determined by reducing the sale value of the inventory by the probable percentage gross margin. The percentage used takes consideration into account consideration inventory that has been made marked down to below at original selling price. An average percentage for each retail department is often used. So when it comes to the measurements, it is important to look at one of the listed company that have inventory that you want to gain better understanding and see how they do, how they go about looking at the measurement of the inventory. Then let's just look at the cost formulas, which start in paragraph 23. In paragraph 23 rather, the cost of inventory of items that are not ordinary interchangeables and goods or services produced and segregated for specific projects shall be assigned by using specific identification of the individual cost. Specific identification of the cost measured that specific costs are attributable to identifiable items of inventory. This is the appropriate treatment of items that are segregated for a specific project, regardless of whether these have been bought or produced. However, a specific identification of cost is appropriate when there are a large number of items of inventory that are ordinarily interchangeable. In such circumstances, the method of selecting those items that remain in inventory could be used to obtain predetermined effects of profit or loss. So this further elaborate the cost formulas. And then we're looking at 25. The cost of inventory, other than those dealt with in paragraph 23, shall be assigned by using the first in, first out, or weighted average cost formula. An entity shall use the same cost formula for all the inventories having a similar nature and use the entity. For inventories with different nature or use different cost formula can be used. So what is important here, you're looking at the nature of the inventory. Any inventory that have the same nature, they should use the same method. That means if you're using FIFO for item that's similar to other inventory, you need to make sure that for other item of inventory that has the similar nature, you are using LIFO, unless you can justify why using other formula was necessary for the inventory of the same nature. And then paragraph 26, for example, inventory used in one operating segment may have a use to the entity different from the same type of inventory used in another operating segment. However, a difference in geographical location of inventory or in the perspective tax rules by itself is not sufficient to justify use of different formulas. So now they're saying, yes, you can come and sit down and say, okay, you want to use different cost formulas for different items items of inventory that has similar nature, and your justification may be the location and the tax, then that is not sufficient enough. So the standard in paragraph 26 is saying that is not justifiable enough to use as a justification. And then we look at 27. The FIFO formula assumes that the item of inventory that were purchased or produced first are sold first, and consequently the items remaining in the inventory at the end of the period are those costs recently purchased or produced. Under the weighted average cost formula, the cost of each item is determined from the weighted average of the cost of similar item at the beginning of the period and the cost of similar item purchased or produced during the period. The average may be calculated on the periodic basis, or each additional shipment is received depending upon circumstances of the entity. So what is important here is that when you're talking about FIFO formula, they are saying whatever that was produced first is also sold first. So that is the most important thing that you need to understand when they are costing the inventory to determine the cost of sales. They are saying whatever the value we paid for the first inventory is what will be sold first. Therefore, the cost that we'll use is based on the cost that we had incurred for that item. Then paragraph 28 is about net realizable value. The cost of inventory may not be recoverable if those inventories are damaged, if they have become wholly or partially obsolete, or if their selling price have declined. The cost of inventory may also not be recoverable if the estimated cost of completion or the estimated cost to be incurred to make the sale have increased. The practice of writing inventories down below to its net realizable value is consistent with the view that assets should not be carried in excess of the amount expected to be realizable from their sale or use. So when the net realizable value came about, it because it was looked at that the sales price, the selling price of inventory might increase, right? So if the selling price of inventory increase, that will influence on the total revenue that will be received. And also, the selling price might have also went down, right? If the selling price have declined, it affects the value of the inventory. And also, if the recoverable amount of this inventory have become wholly or partially obsolete, so that affects or triggers the need to calculate the net realizable value of the inventory. Now we are looking at 29, and 29 says inventories are usually written down to net realizable value item by item. In some circumstances, however, it may be appropriate to group inventories or related items. This may be the case with items of inventory relating to the same products line that have similar purpose or end use, or produced and marketed in the same geographical area, and cannot be practically evaluated separately from the other items in the product line. It is not appropriate to write inventory down on the basis of classification of inventory, for example, finished goods, or all other inventory in particular operating segment. In paragraph 30, estimates of net realizable value are based on the most reliable evidence available at the time of estimates are made of the amount and inventories are expected to be realized. This estimate take into consideration fluctuations of the price or cost directly relating to events occurring after the end of the period, to the extent such events confirm condition existing at the end of the period. Paragraph 31, estimates of net realizable value also take into consideration the purpose for which the inventory is held. For example, the net realizable value of the inventory of the quantity of inventory held to satisfy firm sales or service contracts is based on the contract price. As the sale contracts are for less than the inventory quantity held, and the net realizable value of the excess is based on the general selling price, provisions may arise from firm sales contracts in excess of the inventory quantities held, or from firm purchase contracts. Such provisions are dealt with in the standard international accounting standard 37 provision, conditions liability, and contingent asset. So here now, what are we told is that if there is a sales contract in place, it is easy to determine the net realizable value, because you can look at the estimated price expected to be received from the contract and look at how much the value of this inventory has costed you. If now it happens that the sales price for the contract has declined or is less than what it costed the firm to create or say or buy or brought this inventory, then it means that now there is an issue, a provision has to be made. Paragraph 32, materials and other supplies held for use in the production of inventory are not written down below cost if the finished products in which they will be incorporated are expected to be sold at or above cost. However, when a decline in the price of material indicate that the cost of finished products exceeded the net realizable value, the material are written down to the net realizable value. In such circumstances, the replacement cost of the material may be the best value measures of their net realizable value. The new assessment is made on the net realizable value in each subsequent period when the circumstances that previously caused inventory to be written down below cost no longer exist, or when there is clear evidence of the increase in the net realizable value because of the changed economic circumstances. The amount of the write down is reversed. That is, the reversal is limited to the amount of original write down, so that the new current amount is the lower of the cost of the revised net realizable value. This, if this occurs, for example, when the item of inventory that is carried at net realizable value because its selling price has declined is still unearned, and subsequent product and selling price has increased. So now they are talking about that if there are changes in the internal market to external market about the inventory that was written down to the net realizable value, and then it happens that now the market is doing well, then the revision has to take place. So now we are looking at recognition of expense. So what is the recognition of expenses happen when the inventory is sold, that's number one, or when it is returned to lower of cost or net realizable value. Recognition as an expense. When inventory are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. The amount of any write-down of inventory to net realizable value and all losses of inventory shall be recognized as expense in the period of write-down or losses occur. Right. So now the write-down as well as the sale of inventory, those are the main triggers of the expenses, right? Now let's just look at what comes then. The amount of any reversal of any write-down of inventory arising from the increase in the net realizable value shall be recognized as a reduction in the amount of the inventories recognized as an expense in the period in which reversals occur. So now if there is a reversal in the current year, then that should be taken into account as a reduction in the value of inventory or in the cost of sales. Paragraph 35, same inventories may be allocated to other cost accounts. For example, inventory used as a component of self-contracted property, plant, or equipment. Inventories allocated to other assets in this way are recognized as an expense during the useful life of an asset. And then we're going to look at the main part, which is very important for people who are preparing the financial statements. They need to know how to disclose the inventory. So when we're looking at the disclosure of the inventory, the financial statement shall disclose the accounting policies adopted in measuring inventory, including the cost formula. So it is very important to have accounting policy adopted in measuring the inventory, including the cost formula used. The total carrying amount of inventory and the carrying amount in the classification of inventory to the entity. So the total carrying amount of inventory and the carrying amount in classification appropriate to the entity. The carrying amount of inventory carried at fair value less cost to sell. The amount of inventory recognized as an expense during the period. So what is the value of inventory that is recognized as an expense that was sold during the period? The amount of any write-down of inventory recognized as an expense in the period in accordance with paragraph 34. The amount of any reversal or write-down that is recognized as an expense in the amount inventory recognized as an expense in the period in accordance to paragraph 34. And the circumstances or events that led to the reversal. So the users of the financial statement, they would like to know, why are you reversing the write-down of the inventory? So it is very important that you put the details of the circumstances, the current amount of inventory pledged as a security for the liability. So what is the portion that has been pledged as a security for any liability that was taken into account when this inventory was maybe procured? Then we're looking at paragraph 34, information about the carrying amount held in different classification of inventories and the extent of the changes in this asset in use is useful financial statement users. Common classification of inventories are merchandise, product supplies, material, work in progress, and finished goods. So those are the types of the classification of inventory. So you'll have merchandise, production supplies, materials, work in progress, as well as the finished goods. So it is very important to also shows the classification of the inventory when it comes to the disclosure in the financial statements. Paragraph 38, the amount of inventory recognized as an expense during the period, which is often referred to as the cost of sales, consists of those costs previously included in the measurement of inventory that has now been sold and unallocated production of heads and abnormal amounts of production costs of inventories. The circumstance of entity may also guarantee the inclusion of the amounts as a distribution cost. Some entities adopt a format for profit or loss that results in amount being disclosed other than the cost of inventory recognized as an expense during the period. Under this format, an entity presents the analysis of expense using the classification based on the nature of the expense. In this case, the entity discloses the cost recognized as an expense as raw material and consumables, labor cost, and other costs with amount of the net charge in inventory for the period. So that takes us to the end of the most important things that we needed to understand when it comes to the standard inventory. Now let's just look at the effective date And when you're looking at effective dates, paragraph 14, entity shall apply the standard for annual periods beginning on or after 1 January 2005. Early application is encouraged. If an entity applies the standard for a period beginning before 1 January 2025, it shall disclose that fact. So now you know that if the new standard, it has to be recognized at the certain dates. However, some entities, they do decide to early adopt the standard. So this is a long standard. So it is, or it was effective as from 1 January 2005. That was a long time ago, or plus or minus 20 years as we are sitting here. Paragraph 40, Cap A and Cap B, it was deleted. And then paragraph 40C, IFRS 13 issued in May 2011, amendment the definition of fair value in paragraph 6 and amendment paragraph 7, and entity shall apply those amendments when it applies IFRS 15. So you recall that you have a definition when we're looking at the standard, and those definition in May 2011 there were amendment, and the reason there were amendment is because there was an amendment in this IFRS standard, and they need to take into account of that fact. And then paragraph 40D, it was deleted, and then 40E, it talks about IFRS 15 revenue from contracts with customer issued in May 2014, amendment paragraph 2, 8, 29, and 37, deleted paragraph 19, and the entity shall apply those amendments when applying IFRS 15. Then IFRS 9, which is on paragraph 40, caps F. IFRS 9 is issued in July 2014, amendment paragraph 2 and deleted paragraph 40A, 40B, 40D. An entity shall apply those amendments when applying IFRS 9. And then we're looking at IFRS paragraph 40G. It talks about IFRS 16 leases issued in January 2016, amended paragraph 12, and entity shall apply that amendment when applying IFRS 16. And then we're looking at the withdrawal of the pronouncement. So when you're looking at paragraph 41, the standard supersede IFRS 2, and then standard supersede this one as well, which is SIC 1, consistent difference caused to formulas of inventory. So when you look at this, that take us to the end of the standard. So what is there, it's not that very important, because we talk about the board, the people that were part of this creation of the standard. Thank you so much for listening up until this far. I wish you all the best in any exam that you are preparing yourself for. It could be the matric, it could be the board exam, it could be the CTA, ITC, whatever the course that you're doing that requires you to understand IFRS 2. Thank you so much and all the best.